This week on GTB News, we are not just looking at rising oil prices, but at how one oil shock starts pressuring inflation, bonds, currencies, and interest rate expectations. Right now, markets are reacting to the Middle East not only through the price of a barrel, but through a complete reassessment of the macroeconomic outlook. Over the next 10 minutes, we'll break down why this is happening, who wins, who loses, and which numbers you should be watching right now. The last few days have shown the classic market reaction to an energy shock. Brent surged to $108.56 per barrel, while WTI reached $98.38 after Iran threatened strikes on energy infrastructure in the Middle East. This is no longer just a local oil story. It is a factor that directly affects inflation expectations, bond futures, and central bank behavior. If oil stays expensive, it stops being noise and becomes a tax on the entire economy. The mechanism is simple, but very powerful. Oil is not just gasoline. It is logistics, aviation, shipping, agriculture, chemicals, packaging, and industrial production. When the price of a barrel rises, companies first try to absorb the higher costs through margins, but fairly quickly part of those costs starts getting passed into prices. That is why oil price increases almost always push up headline inflation first, and then, through supply chains, can affect a much wider range of prices. The Fed already has a reason to be cautious. In March it kept rates in the 3.50% to 3.75% range and expects only one cut in 2026, while its inflation forecast was raised to 2.7% by year-end. It is important not to make the main analytical mistake here. The oil rally did not happen in a vacuum. According to U.S. statistics, in January core PCE was 3.1% year-over-year, while overall PCE was 2.8%. In February, food and services also remained under pressure. Separately, the U.S. Labor Department reported that PPI rose 0.7% month-over-month in February and 3.4% year-over-year, meaning producer inflation was already rising before the new wave of energy stress. In other words, oil did not create the inflation problem from zero. It amplified an existing one. Now the key point for investors. Why do bonds suffer when oil rises? A bond is a bet on future money. When the market realizes inflation may be higher and the central bank may be more aggressive, bond prices fall and yields rise. Long-duration bonds are especially sensitive because they have higher duration. Duration is the period it takes to recover the full investment in a fixed income security, taking all coupon payments into account. That means they react more strongly to changes in rate and inflation expectations. Right now, the Fed is explicitly saying that higher energy prices from the Middle East conflict are pushing short-term inflation higher. But oil is not the only thing shaping its outlook. The central bank is also seeing pressure from tariffs and from sticky core inflation. This matters because the bond market is repricing not only the current oil shock, but also the path of rates over the next 6 to 12 months. And that can pull the rest of prices and expectations with it. A price does not even have to rise yet. If enough people expect it to rise, the probability of that move can increase significantly. Markets are used to looking through one-off energy shocks. But that only works when inflation expectations remain anchored. If oil stays high long enough, businesses start changing pricing, consumers change expectations, and the bond market starts demanding higher yields. Then a short-term spike turns into a more durable revaluation. That is why economists warn that if Brent stays near $100 or above, U.S. GDP growth in 2026 could be 0.25 to 0.5 percentage points below the baseline scenario, while inflation could be noticeably higher. That is a very large hit to GDP. The U.S. government's response could have a serious effect not only on the current situation but also on the future. Was it worth it for Trump to start all this or not? That is the question many people are asking, and I will try to answer it next week. For now, we will keep breaking down oil prices and their impact on the rest of the economy. In a shock like this, the main winners are energy companies and some commodity exporters. The losers are aviation, transportation, the consumer sector, and industries where fuel is a major cost. For households, this quickly turns into higher prices for gasoline, shipping, eating out, and everyday goods. The U.S. Bureau of Labor Statistics separately notes that in CPI, energy and gasoline are treated as distinct components, and changes in fuel often show up with a lag in the monthly data. That means the market may react to oil today, while the official inflation data only catches up later, and that lag is often what leads investors to make mistakes. And when we talk about winners and losers, it is not really accurate to say that anyone wins by a lot. Yes, the energy sector may be in a slightly better position, but the oil shortage hits almost everyone who benefits from modern civilization, transport, electricity, store-bought goods, because oil is embedded in all of that. If oil gets more expensive, everyone becomes poorer. The so-called winners are really just losing less than others. The oil shock does not hit bonds only, it also hits currencies. For energy importers, expensive oil puts pressure on the trade balance, and that affects the exchange rate. For commodity exporters, by contrast, it can provide some support. But in reality it is more complicated. If the shock is severe enough, it damages global risk appetite and investors move into safe assets. In that case, the dollar may first strengthen as a reserve currency, and then lose stability if the market starts pricing in a more cautious Fed and slower growth. That is exactly the mix we are seeing now. Higher energy prices are supporting inflation while also increasing fear of slower growth. The first scenario is a short shock. Oil stays volatile, but markets gradually calm down and Brent moves back closer to the $90 to $100 range. In that case, inflation gets a short-term impulse, and bonds recover part of their losses. The second scenario is sustained tension. If threats to shipping through the Strait of Hormuz continue, Brent could hold above $100 and the Fed may keep rates elevated for longer. The third scenario is a long inflation wave. Then the shock goes beyond oil and starts changing expectations for wages, corporate margins, and long-term rates. At that point, this is no longer just an energy story. It becomes a story about how the market is testing the limits of economic resilience. To track the situation in real time, you need to watch 4 things: Brent and WTI, U.S. Treasury yields, market inflation expectations, and Fed rhetoric. If oil stays high and yields rise together with expectations of tighter policy, then the shock has already moved from energy into macroeconomics. If oil falls and the bond market calms down quickly, then we are dealing with a short-term disturbance, not a new regime. The main takeaway is simple: oil is not a separate market. It is the channel through which geopolitics enters inflation, and inflation enters bonds and rates. That means one jump in Brent can change not only fuel prices, but also the outlook for the entire monetary cycle. That is exactly what is happening now. The market is trying to figure out whether this is just a short spike, or the beginning of a more difficult and expensive inflation regime. In the next episode, we will break down who wins and who loses from the start of all these events, and whether the dollar value of that matters in practice. Not just in theory, but in real numbers and real incentives. We will go deeper into aviation, logistics, energy, and consumer markets. If you like this kind of analysis, subscribe to GTB. There will be even more numbers, mechanics, and scenarios coming next.